All right, let's get right into it. Today, we're digging into Intuit's latest earnings report. Now, on the surface, the numbers looked fantastic, a really strong quarter. But the stock's reaction, well, that told a completely different story. So we're going to unpack that disconnect.
So here's the central puzzle we're looking at. Intuit puts up numbers that look like a classic beat and raise scenario, but the market just wasn't having it. Let's start with the good news, the headline numbers that honestly looked great.
First thing you look at, earnings per share. Intuit reported a non-GAAP EPS of $2.75. That's a very, very solid number right there. And here's the thing, that $2.75 wasn't just solid, it beat what Wall Street was expecting by a healthy 9 cents. That's a clean beat. That's exactly the kind of thing you want to see. And it wasn't just on the bottom line. The top line, revenue, was just as impressive. It hit $3.83 billion, which is a whopping 20% jump from last year. You know, for a company the size of Intuit, that is some seriously powerful growth. So you're looking at this, right? A nice earnings beat, 20% revenue growth. You'd naturally think the stock would pop. But nope, it actually dropped about 7%. So what gives? This is the core question, and to answer it, you really have to understand the two very different stories that management was telling on the call.
Okay, so story number one is the bull case. Management spent a huge amount of time on the call painting this grand vision of an AI-powered future, basically positioning Intuit as a key player in this massive tech revolution.
And you gotta listen to the language the CEO, Sasan Goodarzi, is using here. He's not just talking about adding some AI features. He's talking about a virtual team of AI agents. That phrasing is everything. It's the core of their pitch, a whole platform driven by AI that's going to automate pretty much everything for their customers. And you know, this wasn't just talk. They brought some early numbers to back it up. We're talking millions of customers already playing with these AI agents, and even better, the repeat usage is way above what they expected. That tells you the product has legs. But here's the most crucial part. Management made it clear that any money they make from this is pure upside. It's not even baked into their guidance for fiscal 26 yet. Okay, so that's the exciting, futuristic story. But running right alongside it is a much less exciting story, a near-term problem. And that is that the Mailchimp acquisition is still a pretty significant drag on the whole business. And this right here really shows you the two conflicting stories that investors are trying to figure out. On one side, you have this incredible AI narrative and amazing growth in other parts of the business. I mean, QuickBooks mid-market was up 40%. But on the other side, you've got Mailchimp, whose revenue is actually going down year over year. And management even had to admit they're having problems with usability and keeping customers. Now, management says they've got it under control. They talked about a turnaround plan, product improvements, new sales strategies, and they feel pretty confident that Mailchimp will be back to double-digit growth, but by the end of fiscal 26. And that's the key. For right now, it's a headwind. And all of this leads us to the number one reason the stock dropped: the forward guidance. Because despite how good the last quarter was, the market is always looking ahead. And what they saw for the next quarter, well, they were not impressed. This table really tells the whole tale. Look, the full year numbers for earnings and revenue, basically in line. No big surprises there. But that top line, the Q1 revenue growth, that was a clear miss. They guided to 14 to 15% growth, but Wall Street was looking for something closer to 16%. And in a market like this, any sign that growth might be slowing down, even a little, gets punished. And that's exactly what we saw happen here. So after all that, what does it mean for the stock? Where do we go from here? Here's our take on it, the investment thesis, and what you should really be watching for on the next call. So let's just break it down. Our core thesis here is that you have this really exciting long-term AI story that's completely disconnected from the cautious, kind of meh near-term guidance. The market, for now, is focused on the meh part. So the big catalyst to watch is their upcoming Investor Day. That's where we need to see real concrete plans for how they're going to make money off this AI. And we need to see proof that the Mailchimp fix is actually working. Until then, our prediction is for more of this choppy up and down action. We'll be looking for any signs of life in Mailchimp next quarter. If we see it, maybe the stock moves flat to slightly up. So putting it all together, our official call is a market perform rating. Look, the long-term AI potential is undeniable. It's huge. But right now, it's being perfectly balanced by the risk that they can't fix Mailchimp and by that conservative guidance. The stock is probably just going to be stuck in this range until one of those two stories clearly wins out. And as always, just a quick reminder, this is our analysis, but it is not financial advice. The big question we're all left with is this: can Intuit's powerful AI engine really take off before that Mailchimp anchor drags the whole thing down? That is the billion-dollar question we'll be watching.